The Forex market, short for foreign exchange market, is the largest and most liquid financial market globally. It operates 24 hours a day, 5 days a week, facilitating the exchange of trillions of dollars daily. In this market, currencies are traded in pairs, with their values fluctuating constantly based on supply and demand. Traders aim to profit by buying a currency at a lower price and selling it at a higher price or vice versa. While potentially lucrative, Forex trading involves significant risk, especially for beginners. One crucial concept to grasp is margin, a form of leverage that allows traders to control larger positions with a smaller amount of capital. In essence, margin is a good faith deposit that traders provide to their brokers when opening a position in the Forex market. This deposit is not a fee or a cost, but rather a portion of the trader's own funds set aside to ensure the ability to cover potential losses. It acts as collateral, covering potential losses that might occur during a trade. This means that if the market moves against the trader's position, the broker can use the margin to cover the losses. Instead of putting up the full value of a trade, traders only need to deposit a small percentage, thanks to margin. This allows traders to control larger positions than they would be able to with their own capital alone. For instance, with a margin requirement of 1%, a trader can control a $100,000 position with just $1,000 in their trading account. This is known as leveraging. This leveraging power of margin allows traders to amplify their potential profits. By controlling larger positions, even small market movements can result in significant gains. However, it's crucial to remember that leverage is a double-edged sword. While it can magnify gains, it can also amplify losses, potentially exceeding the initial margin deposited. Therefore, understanding how margin works and managing it effectively is essential for any trader looking to succeed in the Forex market. Proper risk management strategies should always be in place to protect against significant losses. Free margin represents the amount of capital available in a trading account that can be used to open new positions or absorb losses from existing ones. It's calculated by subtracting the margin used for open trades from the total equity in the account. In simpler terms, free margin reflects the trader's buying power in the market. For example, if a trader has $5,000 in their account and is using $1,000 as margin for an open trade, their free margin would be $4,000. As trades move in or against the trader's favor, their free margin fluctuates accordingly. Monitoring free margin is vital for risk management and avoiding margin calls. Margin level, a key indicator. Margin level is a crucial metric in Forex trading, representing the ratio of equity to used margin, expressed as a percentage. It is one of the most important indicators that traders need to monitor closely. It indicates the health of a trading account and the trader's risk exposure. By keeping an eye on the margin level, traders can make informed decisions to manage their investments better. A higher margin level suggests a lower risk level, as it signifies a larger cushion against potential losses. This means that the trader has more equity compared to the used margin, providing a safety net. To calculate the margin level, divide the equity in the account by the used margin and multiply by 100. This simple formula helps traders quickly assess their financial standing. For example, if a trader has $10,000 in equity and is using $2,000 as margin, their margin level would be 500%, which is 10,000 divided by 2,000, then multiplied by 100. This high percentage indicates a strong position. Typically, brokers set a minimum margin level requirement, often around 100% or 200%. This ensures that traders maintain a certain level of equity to cover potential losses. If the margin level falls below this threshold, a margin call is triggered. This means the trader must deposit more funds or close positions to bring the margin level back up. Margin call, a trader's warning. A margin call is a notification from the broker, indicating that the margin level in a trading account has fallen below the required minimum. This alert is crucial for traders, as it signals that their investments are at risk. It serves as a warning that the account is at risk of significant losses. The trader must act quickly to avoid further financial damage. When a margin call occurs, the trader has two options: deposit additional funds to increase the margin level above the minimum requirement. This can help stabilize the account and prevent forced liquidation, or close out some or all of their open positions to reduce the used margin. This action can free up capital and reduce the risk of further losses. Ignoring a margin call can lead to the broker forcibly closing the trader's positions at the current market price to prevent further losses. This is known as a forced sale. This situation can be detrimental, potentially resulting in significant financial setbacks. Traders must remain vigilant and proactive to manage their accounts effectively. Thanks for watching. If you found this video helpful, don't forget to like, comment, share, and subscribe. See you in the next video.